Turner, as one of the Midwest's most active venture investors. Guy is a big fan of fast growth and founders who make it happen. Guy's unique path into venture capital includes stops at Raytheon, GE, Chicago Booth, Boston Consulting Group, and Hyde Park Angels before co-founding Hyde Park Venture Partners. Hyde Park Venture Partners is an early-stage VC firm focused on backing the best tech startups and founders in the Midwest and beyond. Pat East has 15 years experience in online marketing, sales management, and executive leadership. As CEO of Hanapin Marketing, the company has experienced over a decade of double-digit revenue growth and profitability. He is also one of the most supportive angel investors in Bloomington. Hanapin Marketing is a premier digital marketing agency focused exclusively on PPC, also known as pay-per-click marketing. Guy and Pat, thank you for being here.
Thanks, Guy, for taking the time to meet with us. So I'm going to ask Guy just a handful of questions on my phone, so I'm not taking notes and just going to read from what I've written down. Hopefully that'll get kind of the audience warmed up, and then we'll open it up for audience questions after that. So, I'd like to start off with, Guy, what is the common trait among your top founders that you wish everyone had?
The single common trait, I think, I would say tenacity is probably the biggest one, but it's in and of itself, it's not sufficient. It's necessary, but it's not sufficient. The best founders we have a pretty good balance of tenacity, and then they're smart, which seems like kind of a throwaway comment, but you have to be pretty smart to navigate the bumps and bruises that you get as a startup founder. And smarts is not general necessarily, it's also very tacit. And so we look for founders who have experience in their industry, but are, enough removed from it that they are ready to innovate in it. So that's part of the smarts, it's part of that IQ part. And then, there's the kind of emotional intelligence part too as well, the EQ part, which is pretty critical in that, that's probably a place that occasionally we've forgiven a little bit too much, but you need to be a really strong communicator and team builder, both internally and externally, because internally talent is the only thing that matters, and externally customer is the only thing that matters, and that's a human-to-human interaction.
And so when you are looking at founders, when you're looking at deals, how do you strike that right balance between they have enough domain expertise to really know what they're doing in the industry, but they're still removed a little bit away from it so that they know how to innovate, what stuff should actually be broken?
Yeah. So I'd say there's two modes of that. So there's the relatively young founder who maybe was in an industry just long enough to get frustrated with it. And that's been a good mode for us. We have two standout companies that would fit that. One is a company called Farm Logs, which is an ag tech company, and the second is a company called Fork Heights, which is a logistics software company. And both of those have founders who were in the space for, depending on how you define things, kind of 3 to 8 years, and really just saw a huge amount of opportunity in it. And then the other are people who have, in one manner or another, risen to the relative top of their fields, and so they're not a cog. They've been a leader in their field, and they may have done that by creating a software company in the past, and now they're doing it again, or they may have done it in the corporate world.
Let me follow up on the EQ characteristic, because you said it's something that maybe you've been a little too lenient on in the past. So could you talk a little bit about why you think you were lenient on it, and why you think it matters so much?
Sure. So I apologize to anybody who is sitting with us over lunch, because I think it will sound very similar. But the nature of many founders is such that they are founding a company or co-founding a company because they don't like to work for other people. They may not be good at working for other people, and they may not so much like working with other people. And that is not true ubiquitously, but it's true in certain circumstances. And I think I see some heads nodding and some people are like, is he talking about me? And yes, no. It's true of myself as well. You know, I don't particularly like working for other people. I like working for myself, and I like working with my partners. And those were choices I made and that we made together in founding our firm. So I get it, right? Like, I get the kind of want to define your own life. But there was this natural selection into entrepreneurship and startup world, which is that, you know, people want to work for themselves. And that natural selection means that there are a lot of founders who really have challenges working with other people or answering to a board. And when I say answering to a board, I don't mean, you know, kind of this chain of command thing, but I just mean collaborating with a board. And that can be really unfortunate, and that can really sell a company and a team short. So that's kind of like a coming in condition to investing in startups, which that's something you have to look for and be careful about and try to filter out.
How do you think, when you're looking for an investment, do you look for somebody that, you know, particularly the characteristic of tenacity, do you look for somebody that is already tenacious enough, or do you want to work with somebody that kind of has a seed of tenaciousness and can kind of work with them over time? So do you want them ready-made, or are you willing to form them along the way?
That's a great question. So I would sort of differentiate in human beings between characteristics and skills. And skills are things that you can learn and improve at, and characteristics are, I don't know, we could argue nature, nurture, but I think if they are learned over very, very long periods of time. And I think tenacity is a characteristic, and it's not going to change. So if the person was not all that tenacious when they were raising capital and you know, had a decent story and were excited, then they're definitely not going to be tenacious when the shit's hitting the fan and they're trying to get themselves out of bed in the morning. So you know, generally speaking, and it's almost like dating in many ways, and I'm certainly not the first person who's made this analogy, but everyone, investor included, should be, when you're first getting to know a company and vice versa, should be on best behavior. Because you're just getting to know each other, right? So if you see anything that seems off, either in the characteristics that you filtered for or sort of in general behavior, then that's a bad sign in both directions. In both as an investor choosing a company to invest in, and as a company choosing an investor to take money from.
It's a good segue into one of my later questions. What are some red flags that you generally see in startups that you end up not investing in?
Yeah. So almost all of the red flags are people related. So there are a few industries that maybe we've lost money in before, or we think structurally are really challenged. So maybe they're small industries, or they're not growing fast, or they're commoditizing. But most industries, it's very rare that an industry makes it a red flag for us. Most of the red flags are about people. So, you know, it's actually interesting. It's a very fine line. Entrepreneurs who are overly pitchy, so kind of over their skis or super selling, make me very nervous. Not every investor, but they make me very nervous. They're relatively rare in the Midwest. It's not really a Midwest characteristic, but there are some people like that. And it's a real balance, because, you know, your chief job as a CEO is to be a salesperson, whether that means you're selling equity to raise capital or you're selling product to get revenue. You know, you have to be really good at sales. But we always get a little bit nervous when we start seeing an entrepreneur get over their skis a lot in terms of what is, the reality that they paint for us, and when we dig into the data, what we really see. I think that's probably the first one. And then the second one is a poor communication ability or lack of tenacity, which, by the way, is sometimes difficult to differentiate, right? So do they take a really long time to get back to you when you ask for something? That kind of thing.
Tell me about, scroll through my questions. What do you, for Hyde Park Venture Partners, what do you wish folks knew about you before taking an investment? Like, what do they not know that they're getting themselves into?
That's a great one. In the good way or a bad way?
Let's start off with a good one.
Start off in a good way. I think we've been pretty helpful with our companies on the talent side in funneling good talent to them. And that's something that we really double, triple, quadruple down on, because the most difficult, the root cause of, I would say the root cause, or one of the key root causes of failure of getting $1 million revenue company to a $10 million revenue company is hiring great people to the senior management team, not to replace the founders, but to work with the founders. And so we work pretty hard at that. That's pretty important. And in our portfolio right now, there's probably 10 or 15 senior executives who we personally sourced or had a significant influence on hiring. Let's see, on the less good side. I don't know if this is specific to us. We are there for our companies in the trenches when things don't go well, and we'll do everything we can to help. But at some point, every investor has to cut their losses, and we understand the risks that we get into when we invest in a company, and hopefully the entrepreneurs understand the risk as well. And there's a 50 to 60% chance that the company actually turns out to be nothing, like literally zero. Maybe that's 40%, maybe it's 60%, depends what stage you're investing at, depends what stage the company's at. But when things start going in that direction, there's only so much we can do, and there's only so much we will do, and that's to be fair to our other companies and to our investors. And I think relative to a lot of investors, we've been pretty involved in trying to salvage whatever we can, both for investors and entrepreneurs, but at times you just sort of have to step back. And the first thing that you think about is, well, are they going to give you more money to survive longer? And the basic answer to that is, if things aren't going well, don't expect your investors to give you more money. And that's a good rule to live by for both sides.
And so when you obviously if a company ends up dissolving, it's pretty easy to see that, okay, I'm just not going to put any more resources in it. There's nothing to put resources into. At what point do you start seeing where maybe you should start taking a step back? What are the signals that maybe the CEO isn't responsive to you, or they're not hitting plan, or are there other tangible signals that kind of indicate to you that, all right, I need to cut bait now?
Yeah, and it's funny, I'm going to use some descriptors, and they all sound very derogatory, but they're, they sort of describe a business condition and also a human condition. And so the first one is flailing, and the second one is kind of throwing shit against the wall. And they're different, right? Flailing is like a combination of, it's a little bit of desperation and sort of going through lots of things in your head, but never actually making them happen. So today our strategy is this, next week our strategy is that. throwing shit against the wall is a slightly more elongated version of flailing, where you actually try things, but in kind of rapid order and too quickly to be able to learn from them. And neither of these are the root cause. They're the symptom, and they're typically the root cause is typically not selling enough of something quickly enough. And then you see those types of behaviors kind of step in. And so what you'd say was, well, okay, well, that's nice, guys. So if a company is flailing or throwing shit against the wall, what should they be doing instead? And the answer is, if things aren't going to plan, to Pat's point, well, then you need a new plan. And you need to, cut costs so that you can live within that plan and buy yourself more time to try one or two things to see if you can affect a change and start getting revenues. And when we see, and so typically we'll see companies, successfully navigate to a new strategy and give it a shot. And sometimes it works and sometimes it doesn't. But what is a really early negative indicator is the flopping around, because you just never get anything done.
I still have a bunch more questions left, but I think maybe it's a good time to open it up to the audience and see what questions you guys have. Yeah, Peter.
You talk about liking high growth and low churn. Can you put a number on both of those?
Sure. So a company that's doing, so we do mostly B2B software, so companies that sell software to other companies, but we also do some marketplaces. But for simplicity, I'll talk B2B. So the best-in-class growth curve for a B2B software business is a company that starts in their first selling year, they sell $200,000 of revenue. In their second selling year, they sell $1 million. In their third selling year, and I'm talking about run rates, but
Right.
figure it all out. Second, it goes to 3. In the third, second and third, it goes to 3. Fourth, it goes to 9. Fifth, it goes to 18, and onwards from there. So that's roughly 5, 3, 3, 2, and then hopefully you have some more 2s and 1.5s and stuff. Okay, so that's the revenue line. What does the cost line look like? So we like to see companies do that capital efficiently, which means that, roughly speaking, if they add $1 million in revenue, that they burn about $1 million. So that's roughly a 10% efficiency. I think about it on a monthly basis, but there's lots of blogs on it. I won't go into too much detail, but think of it this way: if you add $10,000 a month in monthly recurring revenue, so last month I was doing 50 in MRR, this month I'm doing 60 in MRR, and I burned 100,000 to do it, or less, that tends to be best in class. That means if you're burning $1 million a month, you're adding how much? About 100,000, right? So, or more. That would be more than 10% efficiency. And if you map all that out, you get to a company that gets to about $15 million in revenue and about $15 million in capital, which is, it's good. And there's some companies that do better, and most companies do much worse than that, or never are able to raise to get there, or never get there. So churn plays into that too. Churn is kind of hidden into the cash efficiency number. But generally speaking, for B2B software companies, we're looking for net negative churn, meaning that if you just sat there with your existing companies, that year over year, with your existing customers, year over year, that revenue base would grow. You may lose some customers, but you upsell some other customers and they make up for it. That's the generic answer. Yeah.
Does it matter for you where that total ARR comes from, whether it's in your a majority of it comes from net negative churn or new customers? Does that factor into kind of how you want to see your startups grow?
Yeah, that's a great question. So we had one company we invested in. It had about $60,000 a month in recurring revenue, and maybe about 5 or 6 customers. And over our relationship with the company, they got to, let's see, they got to almost 400,000 a month in recurring revenue. That sounds pretty good, right? So they went from 60 to 400, so it was like, what, 8x or something like that, 7x. And hypothetically, we should have felt pretty good about that. But they only added about 2 or 3 customers, and almost all of it was organic growth. And the problem with that was, and in the end, you know, long story short, we sold the company for scraps. So I think on average across the different rounds, maybe a third to a half the money came back to investors. And the reason is that no one looking to buy the company or invest in the company to keep it going was convinced that it truly had product market fit. So it may have had $4 million or actually almost $5 million of revenue. But people looked at it and said, is this just a kind of a customized solution for 8 customers? Or is it really scalable? And I mean, we didn't know the answer, and we were existing investors, so we couldn't have expected someone else to come in and be convinced either. So the answer is both matter a lot. I think, you know, generally speaking, we like to see a little bit more revenue growth than we see customer count growth, which basically implies that your annual contract values are going up. But it's not an all or nothing thing.
Awesome.
Do you guys have some metrics and dollar figures on the size of industries that you're willing to invest in, at least the floor
Yeah.
of the industry, market cap of the industry?
Yeah.
Assuming that the startup has a really good hold on it, it would have terrific margins, but what would you think the lowest size industry you guys would be?
That's such a good question, and I actually think that there's a lot of debate about that right now because of increased investor focus on vertical SaaS. So horizontal SaaS is SaaS that sells through functions in companies, so it sells into the CFO, it sells to marketers, but it could be across any industry. And vertical SaaS is software that sells into a vertical, so maybe ag tech or logistics. And so there's some very successful Valley investors who would say, look, you can build huge vertical SaaS companies, but you have to believe that they can get large percentages of the market, which is unusual, right? So if you've ever anybody here has ever gone through a business plan class or put together a business plan or something, the coach will tell you, don't show investors an assumption that you're gonna get more than 5% of the market, right? Because very few companies actually get 5% of the market. Guess which companies get more than 5% of market? Anybody know? The really fucking valuable ones. Right? So, you know, if you're making a SaaS bet, you sort of have to believe there's a potential to get a large portion of the market, which would then also say, then you might be willing to have a smaller market. But at some point, small is small. And I would say generally, there's very few investors who consider markets less than $500 million a year annually, and most prefer more than $1 billion. And so let's do the math on it, right? So let's just say it's $1 billion market, and I'm gonna do all multiples of 10. Okay, it's $1 billion market, and I'm gonna try to keep track of them too, which is gonna be harder. Again, $1 billion market. A company within that market gets to $100 million in revenue, and they're valued on a multiple of revenue at 10x, right? So how much is that company worth? It's worth $1 billion, right? So $100 million of revenue times 10x multiple is $1 billion valuation. It represents 10% of $1 billion market. Okay, so I have a $500 million fund. I don't, I wish I did, but I have a $500 million fund. How much of that company do I have to own in order for it to have a real impact on my fund? Remember, my goal is to take my $500 million fund and return at least $1 billion. I need to own half of that company, because if I own half of that company, what happens?
Your 50 million is worth 500 million.
Right. If I own half of that company, the 50%, I sell the company, it's worth $500 million, and I've returned my fund. And then I need maybe 1 or 2 or 3 other deals to go really well in the portfolio, and I'm killing.
Raise fund too.
Right.
Yeah.
Right. Exactly. Does anybody here know a venture or an entrepreneur who's sold half of their company to a venture capitalist? No, it's not the way it works, right? So VCs usually lead rounds that take 25 to 35% of the company. So the math doesn't work all that well. If you have a market size, even sometimes it's $1 billion.
But do you guys have any, do you guys ever dabble in smaller market stuff, or?
Not on purpose. Yeah. We have by mistake. Yeah, we're in one company, I'll leave it nameless, and it's funny, we invested in 2 companies in this general market, but the sub-market, you have to be very specific about which market it is. And I'll tell you the problem that we experienced was, we said, okay, there are 2,000 companies that would buy this B2B software in this market. I'm not going to get too specific to protect the guilty. No, we're the guilty ones, we invested. So let's say there's 2,000 companies in this market, and we looked at them all and we were like, yeah, that's not that bad, because you think 100,000 each, 100,000 a year each is the potential that we could sell into, and I don't know, you do a lot of math, and I think it's $2 billion, but I don't know, someone correct me. Maybe it's 200 million. 200 million, right? And you look at that and you're like, all right, well then, if it's vertical SaaS, I can get a nice chunk of that market, blah, 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 blah. So what we found is that only the largest of the customers in that market really find value in the software. Only about 50 or 100 of those customers. Now the good news is they're willing to spend more than 100,000, but not more than $1 million. And so the true addressable market size is probably around 50 to 100 million. And it's just not big enough to make a big company. In growth rates, we need real growth rates. So double digit is preferred. There's not that many billion-dollar markets growing at double digits, but there are some. And anything less than 5, you're probably in trouble, because the market's commoditized, and there's in the end, a human being has to buy software. It's not a company, and that human being has a budget. And if that budget is getting smaller, they don't want to buy your software.
So what would you say are the characteristics or pluses and minuses of Midwest startups, or startups that at least emerge from the Midwest versus the coasts? And for those of us that create Midwest startups, how can we use that to be successful in a highly competitive coastal environment?
Yeah. So I think probably I guess I'll give you a two-part answer. So, and they're associated and maybe correlated. The first one is that Midwest capital or Midwest companies by necessity tend to be more capital efficient. They have less access to capital, and therefore they tend to spend less. Now the flip side of that is many Midwest entrepreneurs will take less risk because it's harder to take risk if you have less capital, or if you're putting your own capital to work. The second part is Midwest technology companies have much better access to capital at the junior and mid-level stages of a company. Definitely the junior level. Mid-level depends what city you're in. Senior level, the coasts do have an advantage. But most of the cost base in a company is driven by the junior level. And so if you're fighting Google for entry-level engineers at $150,000, that's a real disadvantage in the Valley versus being in Bloomington and paying someone maybe $65,000. And by the way, the $65,000 engineer in Bloomington is living a better lifestyle than the $150,000 engineer in the Silicon Valley. They've got a car, they have a house, they can buy a house, they send their kids to good schools. They have kids. No 22-year-old has kids in Silicon Valley.
As a VC firm that really focuses in on talent, I 100% agree with you that 65K in Bloomington goes much further in Silicon Valley, or here than Silicon Valley. How do you convince people when you're recruiting that that's actually the case, and you're not simply duping them? When we recruit people, we pitch that all the time, and about half the time we can convince somebody to relocate here. About half the time they think we're just trying to give them a lower salary offer because we can. how do you get past that?
You know, that's a good question. To be honest, I'm not sure that I have enough on-the-ground experience in recruiting junior and mid-level folks to evidence, you know, how to do it best. But I'll say two things. The first is, if it were me, I would drive people around with a realtor, is what I would do. I mean, it's just like you buy a house for $100,000 here that you might actually want to live in, reasonably close to town. And in Silicon Valley, you can't buy a house for less than $2 million. I mean, it's an order of magnitude different. And you know, even the dumbest smart engineer can understand that, having been one myself. So that's number one. And then number two, the other way our companies get talent either to stay here or to return here is affiliation. So Drive Capital, which is a Columbus-based fund, and it's large enough to have at least one and maybe two people dedicated to recruiting. They basically just go through all the top talent in these West Coast success stories and look for people who are from the Midwest, or maybe who went to IU or went to Michigan. And they call them up and they're like, hey, remember how awesome it was being in a college town? Guess what? We'll bring you back here. Now, at those mid-level and senior positions, you don't get as much of a discount, right? So you do tend to have to pay more market-based because while the cost of living is very different, cost of living differences matter most when you're more junior because housing is a much larger part of your salary. If you're mid-career, then you know suddenly you're doing things that are pretty consistent across the country, like saving money for your kids' college, or going to Cancun, or whatever else you feel like you need to do.
So what skills have you seen companies you've taken on need to either acquire or build to go from starting a company to growing and scaling a company?
Yeah, so that's a good one. I think here's one of the mistakes I'll answer it in terms of a mistake. Here's one of the mistakes we see most often is, all right, so we see product market fit and go to market in a couple different stages, but first thing that happens when you launch a product is you sell it, right? And who sells that product usually?
The founders.
The founder sells it. And then the founder sells it a few times. And then the founder's like, I'm onto something. They hire a salesperson. And the salesperson sells it a few times. And then they're like, we're onto something. I'm going to hire another salesperson. And then suddenly you have 2 or 3 salespeople. Maybe it's called a sales pod. And it includes a junior salesperson who qualifies leads and sets up demos for the head honcho who closes things. Okay? This is a sales pod. And on this sales pod, the company has gotten to adding $500,000 a year in revenue, and it's now at a $500,000 run rate. And I won't go through complicated numbers on annual contract value and number of customers, but you know, you have a sales pod, they added 500. So how many sales pods do you need to add $5 million?
If they're each adding 500.
What's that?
If they're each
adding 500.
500,000. 10.
You need 10, right? Well, so suddenly your team went from 3 people to 30 people, and you need to hire all those people between now and about 9 months from now in order to hit that goal at the end of next year. Remember, because I said kind of like 5-3-3, right? And the challenge with that is it takes a while to hire people. It takes a couple months. To hire 30 people, it would take you to hire 30 good people, important caveat, salespeople, probably at least 3 months in Chicago. So you lost 3 months there, and then you know half of them are going to suck, and you're going to have to fire them. And depending on how long the sales cycle time is, it takes a while. So in other words, that math is not perfectly scalable. You can't just 10x by adding 10 more sales pods. And what has to happen instead is that to get that type of growth, you have to do some of that, but you also have to increase your contract value. So you have to increase your contract value from, say, $25,000 a year per customer to 50, and that's how you get half of the scaling. So your efficiency per person goes up. But guess what? That may require a different type of person, because it's not just the smile and dial, it may be an industry vet who knows how to talk the talk and walk the walk, and may need to get on an airplane and represent your company with a customer live. So what you're suddenly seeing is, in order to really scale, the company is needing to go upstream, and in order to go upstream, they're often needing to include different types of talent on the team. And those are the two really hard things. So going upstream and adding new types of talent are hard. You have to experiment, and there's always going to be failures. So we've seen a lot of companies get to $2 or $3 million in revenue, kind of on the small to medium-sized business inside sales pod approach, and it doesn't scale past that.
And as a follow-up about, when you're sales rep, maybe it requires a different skill set. How do you have that conversation with your sales reps? Is it just you yank them all and find somebody, a new VP of sales? Do you try to train them and over time turn them into the salespeople you really need them to be? How do you handle those situations?
The best salespeople scale with companies. They really do. I mean, and they're very rare. I mean, what we've seen is, it's funny. People always talk about 10x engineers. So the best engineer is 10x more productive than the least best engineer. And I don't know. There's probably data around that, and I don't know. It seems to make sense. Like super nerdy people are like they do some cool shit. It's true of salespeople as well. I mean, it really is true, especially when you start considering, like, unlike the engineers who, you may nip off the least productive ones, you may chop 10% of that workforce that's really not producing, but remember, you're kind of in a battle for engineers. It's hard to hire them. They don't get cycled through as much, and having been an engineer, that was great for me. But salespeople, you cut off the bottom half, or you cut off the bottom 40% pretty religiously. So when you actually think about the entire distribution, the most successful salesperson who's like hitting 150% of quota is literally 10x better than the worst. So that person can grow, and you put them on an airplane, and you put them in front of a customer, and you see what happens. Or very often you do both. You don't get rid of the sales pod model. You may keep that, but then you also add enterprise sales. Because the challenge with enterprise sales is, well, let me kind of contrast them. Inside sales, medium-sized business, kind of rinse and repeat inside sales, it's less scalable, but it's much more predictable. And enterprise sales, you can start, grabbing off some really big chunks at a time, and once you hit predictability, can really zoom up a growth curve, but it takes a long time to get predictability. So if you do a little bit of both, it's kind of a good way to hedge.
Okay.
There's a real paucity of pre-seed and seed capital in this region.
Yeah.
Probably in the Midwest in general. So I suspect most of the entrepreneurs in this room are making a calculus between, do I grow organically slower, or do I take other people's money?
Yeah.
So I'm curious how you would help inform their calculus. Grow organically or take other people's money?
That's a good one. So, without getting to the whole discussion of should you stay here, should you move to Chicago, should you move to Silicon Valley, which is about proximity to capital. Let's just say you do have a choice between taking capital or not taking capital. I think a lot of it depends on the industry you're in. If the industry is moving very fast, then you're disadvantaged in not moving very fast in the early days. I'll come back to that in a second. And so, consumer tech is a space you need to move fast. FinTech is another space that seems to be moving pretty fast. Healthcare tech, like healthcare IT, less so. So being capital efficient early on and getting some customers on without burning a lot of capital can be a pretty good idea. Any winner-take-all spaces, marketplaces, stuff like that, there is a real benefit to moving faster. But to me, that's all about, what I just said is really about the earliest stages. So finding your early customers, getting early product market fit, maybe starting to prove some scalability in the model. The only challenge with, at some point though, you kind of have to decide which route you're going to go down. Am I going to go down the venture capital route and try to achieve 5-3-3-2? Or am I going to go the more organic route and maybe grow 50% a year for the next 10 years and build a huge business without taking much capital? It's hard to switch between the two because I'm looking for 5-3-3-2, and you may do 50% without taking any capital, but I'm not certain if I give you money that you can go from 50% growth to 300% growth. And we haven't seen a lot of cases where entrepreneurs are able to go from like very good solid growth to hyper growth, because it's a different mindset, it's a different talent DNA.
When you talk about upselling within the business, or kind of related to this question, it seems like a common trend around here is to rely heavily on managed services to grow early. We have software, but really it's people doing things for you behind the computer and saying it's software.
Yeah.
What is, I guess, my perception is that that's more common here in the Midwest as a way for people to get their business off the ground and generate revenue. Do you see that, and is there like a turning point when you really, when you're evaluating deals, say, what is kind of your litmus test to know if someone is too heavy dependent on managed services versus software service?
So define managed services for me. Like, give me an example.
I guess upselling related on consulting work, but that doesn't really give you an example. Like, I think of ExactTarget a lot, honestly, because their software was not great, but they had a very, very good team that would handle Nike-type clients with their team. And so basically my question would be, in your mind, was the ExactTarget acquisition a phenomenon that was possible at a time when software maybe didn't have to be as good, versus that you see the shift to where software design and experience and functionality has to be really more what people are buying than the...
I think it depends if you're an enterprise or if you're in small, medium-sized business or direct to consumer. So service is always a part of enterprise, always. It doesn't matter. And it's not clear to me, at least until very recently, and it's still not all that clear, that the best product wins in enterprise. And in fact, I think ExactTarget is a perfect example of it not being the case. And that team would agree to that. And they're very proud of the fact that they were a sales machine and a service machine. But their managed services was, 20% of the company, 25% of revenue, which is actually about right for enterprise. But for small and medium-sized business, I think the bar has really come up, and you got to do software. Because, businesses are now a bunch of consumers who are very used to making choices about software. But at the enterprise level, it's more complicated than that, and you're concerned about things like continuity and integrations and data access and things that mean that the pretty screenshots are not all that matter. I don't know if that answers your question. I might also, you're talking about relatively mature companies, which is a great point. If the question is more about, is there more vaporware here or in the valley, then I think it's in the valley. Yeah, because everyone has a story out there. Everyone's pitching something, and most of it's bullshit. And that's fine. Like you start with a really wide funnel, and you get down to a pretty awesome a large set of startups, and then enough really large ones. And maybe here I almost wish there was more vaporware, right? Get more things, get more bullshit started.
Kind of related to that, what type of signals do you look for for the onset of bubbles or valuation bubbles. You know, say ag tech, for example.
Yeah.
Right now, where you have companies doing deals at ridiculous multiples. What kind of things do you look for to say, okay, enough is enough? You know, maybe some of the valuations are just way out of whack right
Yeah.
now.
You know, I think a lot of it comes down to what you have to believe to justify multiples. So, you know, the way we think about every deal, every large deal that we do, we want to have the potential to return half the fund or more. Only a very few of them will. But we have to believe in that potential. And so the denominator, which is the price you pay in at, to achieve that kind of numerator, has to be low enough such that you get the kind of return we're talking about with Jane, right? And one of the things that we've seen in these bubble markets, so certainly in 15 and then in certain industries since then, are when you sit down and you do the math that we all did about the $1 billion market, and you have 10% ownership and your fund's $500 million, it's unbelievable to think about what a partner at $1 billion fund is pitching to their other partners on exit potential for some of these deals. Because the number of very large exits is few and far between, right? So, but there are other times when you're like, you know what, that's not that crazy, right? So things that you wouldn't necessarily expect. You know, so is the meal kit market in a bubble? I don't know. What do you guys think? Meal kit market, bubble? Anybody here use meal kits? Meal kit? Anybody else? You tried it.
I tried
So
it.
raise your hand if you tried it and churned. Yeah, that's not so great. But you're still using it. It's good.
You're talking about the packaged food?
Yeah.
Yeah, oh yeah.
Which one? Plated, Blue Apron?
Fresh.
What's that?
The fresh, there's a fresh.
HelloFresh? Yeah. So those companies have raised huge amounts of capital and at pretty high multiples, given that it's a relatively low margin business. But what's the saving grace? It's a huge fucking market. It's like a $3 trillion market, right? It's not actually 3 trillion, but food spend is, I'm just gonna make it up here, it's $18 trillion GDP in the US. I think probably 3 billion maybe is spent on food, and about half of that is spent in the home.
3 trillion?
3 trillion, sorry. About half of that is spent in the home. $1.5 trillion of groceries. So what you have to believe for one of those companies to become a $20 billion company is not that crazy. What you have to believe in terms of market share. So the answer is it really, really depends. And there's somewhere it makes sense and there's somewhere it doesn't.
Yeah. What's your favorite holy crap valuation in the last few years? You know, something that's like, you know, one of the that feels sort of unrealistic, but you think actually probably has a backbone.
So I think, you know, it's interesting. So the one that people would gravitate to probably instinctually would be Uber, but it has the same thing as grocery. It's an enormous market, and so that one I actually believe. Pinterest, I think, is probably a bit of a struggle. I think Pinterest is doing like $300 or $400 million in revenue, and it's at like a $20 billion valuation. So I think the path for that, and if you look at what happened with Twitter, I think the path for that to go public and, you know, have a bump is tough. And, you know, it should be a very monetizable platform, but it hasn't worked out as they thought. So, I mean, who here uses Pinterest? 2, 3-ish, 4-ish. Who here uses Twitter? And obviously everyone sort of uses Facebook, I'm sure. So that's tough. I think that's
it sounds like you're kind of touring the Midwest a little bit, and I'm sure you've made a number of investments in different places.
Yeah.
Maybe you can share a little bit, just community-wise, what you like to see, and a lot of the folks in the room here have done a tremendous job of helping move Bloomington along and make it more, I think, attractive and easier for folks to start companies. But what have you seen that's successful and others that we might model as we
Yeah.
continue to build the ecosystem here?
Yeah. So I think there's really, there are apple, oranges, and mangoes,
Right.
because we invest in Toronto and Chicago. Those are both enormous cities. Then we invest in Indianapolis and, Columbus or Minneapolis, which are like the next tier down,
Yeah.
like 1 million people each-ish, I think.
Yeah.
How big is Indianapolis?
If you count the whole MSA, just about 1 million.
That's about 1 million,
Yeah.
right? And then you have like the next kind of, I would say Madison. Madison's about 500, and the MSA, I think.
Yeah.
But then you go down to Champaign, Bloomington, Ann Arbor, West Lafayette, and so it's different. And you can't judge them against each other. I think the characteristics that probably the standout city, and I don't mean to compare, but
Yeah.
you asked me to, so whatever. Probably the standout city of the 50 to 150,000 person college towns is Ann Arbor.
Okay.
And there's a pretty long history there. The state has for a long time had a number of programs to fund venture funds, which had incentives and requirements to invest in the state. There's been a couple angel groups active there, but the other thing is there's been some successful outcomes there. So Arbor Networks I think was founded there. Barracuda Networks, I believe, had a big office there and had a huge outcome. And so there was a number of execs floating around there who have been successful and have made a lot of money. And they started putting some of it to work through angel groups, and then there were these funds that the state had kind of helped seed and start and attract in, and so you kind of had that moving along.
Okay.
So I think what are the lessons learned there? You need angels to step up, and when I say you need angels,
Yeah.
one needs angels in order to start these ecosystems who are willing to put money in and lose it, because most of it will get lost. And it's as much community service as it is investment. And so I think that's kind of step number one. And then a few entrepreneurs like Pat and others who have the experience of really building something and having some success and being able to offer advice. And that's probably the hardest part. It's funny, there's a lot of money around. There's just a lot of money. I mean, the stock market's up 3x in the last 5 years. There are a lot of wealthy families who've been in the Midwest for centuries. There is a lot of money, and you just need a few people to go kind of beat the bushes and start getting it to flow.
Okay. Thanks.
Can you talk more about the life of a successful angel investor? What's that look like for someone starting, if you want more people in the community?
The life of one?
Or how does one get started? What makes it work for a successful angel investor?
Well, I think it depends what the angel investor is trying to get out of it. So if the angel investor is literally trying to earn a living from it, and assuming that they're starting off with some real money to start with, and maybe they're worth more than $10 million, and I think if you're worth less than $10 million, or don't have a very high income, then it's not a great idea. But if the idea is to take that $10 million and turn it into $30 million in 10 or 15 years, there's easier ways to do it than angel investing. If the idea is, I really want to, I was a successful entrepreneur and I want to help other successful entrepreneurs, and part of the way I'm going to do that is by putting some money to work, then I think that's very, very powerful, and I think that's why most angel investors do it. And then I think there's ones who are like, I am a community booster and I want to overall boost the community, and maybe maybe I'm a really successful attorney and don't know much about startups, but I can at least help with my capital. That's another mode. And I would say most angel investors, pure angel investors I know, feel pretty lucky if they return their capital or make 2x off of it. But remember, they could have done that in the stock market pretty easily. They could have invested in campus housing and made a killing. Or parking. True story, right? There's a lot of ways to make money that are easier than angel investing. I don't know if I answered your question.
That's helpful.
Yeah.
Do you look for single founder companies, or do you look for multi-founder companies?
You know, it's funny, most of the stuff that I say is like not based on any data, it's like anecdotes. But this one, the answer to this question is based on data. So there's a great book called, oh shoot, what is it called? I'll have to remember, but it'll come back to me. Professor at Harvard did a bunch of studies, longitudinal studies on startup teams. And the maximum for success based on, as a function of number of people on the founding team, is between 2 and 3. And there's an extremely low, like it goes from way low at 1, and then goes past 2, peaks between 2 and 3, comes down at 3, and then starts going down pretty rapidly after that. Noam Wasserman is the guy's name, N-O-A-M Wasserman. It's a great book, but I can't remember the title. And yeah, the data's pretty clear. And so then the question is, well, why is that the case? So remember when I talked about there being kind of a natural condition of entrepreneurship where it's made up of people who don't like to work with other people and don't like to work for other people? Well, if you're a sole founder, it's pretty fucking clear which camp you fall into. So, if you're founding a business alone, it's already highly likely that, or a founder that is founding a business alone, it's already highly likely that they have challenges working with other people, and either they selected themselves into being alone or other people selected them into being alone, and that'll be very tough to build a business that way. Again, I'm being hyperbolic here. And then the other part about it is I actually think 2 or 3 people make a lot better decisions than one, and that's because of diversity of experience, and that's because of having multiple points of view. So that's we really avoid sole founders. I think we've done it effectively once, and it was a total fail.
And to follow up on that, as a solo founder, it is extraordinarily hard mentally to get through the tough days, because the only person you have to rely on yourself is you, who's already having a bad day, right?
And you're crazy, like,
It is, it's tough. So, I would, next company, co-founder.
Yeah. Or have an amazing husband or wife.
Yes.
Right. So yeah, there are always exceptions, but what's interesting is if you look at all the huge public tech companies, almost none of them was founded by one person. We hear a lot about Steve Jobs, we hear a lot about Zuckerberg, we hear a lot about all these folks, but they all had co-founders. I don't know if that's true. Is it true of Oracle?
Ellison was a solo founder.
Yeah, and I think Tom Siebel might have been too. Anyways, whatever, they're out there, but.
I know it's kind of anathema, especially in small towns, to kind of think this way, and I understand why in terms of economic development. But do you guys have a stance on startups utilizing overseas engineering talent to suppress costs, at least in the early stages?
Yeah, we've got, for us it's a little bit about cost, but I think it's more about, actually cost is pretty meaningful now that I think about it. Probably three of our best companies have outsourced a large part of their talent base, engineering talent, but not 100%. You still have to have some people here, certainly more product side here, and then some engineers here. And it's very diverse. I mean, we've got, I think, Costa Rica, I think they just did that for fun. And then Ukraine, India, and then I think I'm missing somewhere else. So there's great software talent all over the world. And Yeah, I wouldn't say we encourage our companies to do it, and I think early on we were a little bit nervous about it, but it seems to have worked.
Can you talk a bit about features and maybe featureitis versus having the best product? Is that a clear question?
Yeah. So there's features, there's products, and there's platforms. You know, I think and I'm not exactly sure what the difference is between a product and a platform, but one's bigger than the other. There are very clearly sometimes features that you see that come out. So, you know, one of the most featurey type of, just to put it in real terms, one of the most featurey types of products, and I believe there's someone here who may be working on something similar. This is not targeted at you, but this has been an ongoing discussion for years as these products are coming out, are scheduling products. So Calendly, Tungle, and there's a bunch of these that have come out over the years, and I'm an avid user, Assistant.io, I'm an avid user. But it kind of feels like that's a feature of your Office suite, right, of your email and scheduling. So there's an argument to be made there that that's really what it is, and that can be a challenge. It's hard to build a big company off of a feature. You might be able to get some nice customer traction and then sell it into the parent product or the parent platform. And then, yeah, then there's platforms. You know, there's very few startups that are truly platforms. So I think of a platform, Salesforce is a platform. It addresses the needs of multiple functions inside of a company, becomes the system of record, and then a lot of other companies actually develop on its platform, right? But that type, I mean, it took Salesforce a decade to get there. For a long time, it was just a problem.
Yeah, I was actually asking, sorry, I thought that might not have been a clear question. I'm asking about one customer says they want another feature, and you have to decide, is that going into the weeds? Should I really get every feature that all my customers want?
Yeah.
Do I need to get 8 out of 10? Do I need to get 10 out of 10? And just what are some thoughts you had about, these are good ones to add, these are ones to ignore?
Yeah, so it's funny, that I think that goes back to James' question of how do you balance bootstrapping versus raising capital? Because if you're bootstrapping, then the question is, well, how much are you willing to pay for it? If you're raising capital, the question is, how many more people are there like you? It's a simple trade-off. And it's one of the classic trade-offs of bootstrapping versus raising capital. But I think, you know, usually the relatively structured answer is, if it is a need within the segment that you are targeting, and it's table stakes, you better get it quick. Like, in other words, if it's how a customer is going to decide between you and someone else, that's not even necessarily table stakes. That could be differentiation. But if it's something else your competitor has and other people and customers use a lot, you need it. If it's a differentiating feature and it's, you know, how in the long term you're going to win, then, you know, and people really, other customers in your segment want it, then you probably do want it. Does that answer your question?
Sure.
Are we out of time?
We got, let's do one more question and then we'll wrap up. Simon.
Yeah, so obviously, you know, you invest in the founder's company pitch, you invest in that plan, but as we know, startups, you know, in business things change, sometimes you have to make a pivot. Is there a time when a pivot is too much for you, and do you expect a company to let you know if that occurs?
We definitely expect the company to let us know if they're pivoting. But you know, we do a large range of investing, so $100,000 checks up to $2 million. You know, my response when a $100,000 check is company is pivoting is, cool, thanks for letting us know. How can I help? You know, the $2 million companies, it's like, let's talk more about that. So that's the communication piece of it. But the more you communicate with investors, the better, whether things are going well or not well. What was the other part of the question?
Just what do you expect after an investment? You know, just updates, or do you just kind of sit back and let it go, or?
So for our seed investments, our early small investments, we basically say we want to be helpful but not annoying, and we can only be helpful if you let us know what's going on and what you need. And there's a whole range of the extent to which entrepreneurs rope us in. And sometimes we're pretty involved at seed, and we have to be careful with our time. But we can get fairly involved if we get pulled in. For the later stage investments, it's a pretty regular communication pattern. I mean, I'd say we talk to each of our larger investments about once a week, and we spend meaningful time with them probably every other week. And it's not about board cadence. I mean, board meetings should not really be your milestone for decision making at a really early stage company. Yeah, it's sort of ongoing and fluid. Cool. Thanks everyone. Really appreciate it.